Send it now over to executive editor Brian Sozzi, live at the Goldman Sachs Communacopia and Technology Conference in San Francisco.
Hey, thanks so much, Jared. Yeah, the crowd's starting to pick up here at the Communacopia conference. I'm here with the really man of the conference, I should say, Jan Hatzius, Goldman Sachs chief economist. Jan, always nice to see you here at this event. I think this is a market trying to figure out what in the world is going on with the U.S. labor market. It is really decelerated. What is going on with the labor market, and how bad could things get?
Clearly, employment growth has decelerated. Right now, we're looking at 29,000 on average new jobs created in the last 3 months. This is a preliminary estimate. We've learned that these numbers can get revised, but I think it's quite clear that employment growth has fallen to levels that are below the longer-term labor supply trends. That's why the unemployment rate has started to edge up. That's why household employment to population ratio has come down. So I think in our baseline, this is a period of weakness with an increase in the unemployment rate of another couple of tenths maybe, that then starts to recede as we go into 2026, when we have the economy picking up a little bit for a variety of factors. But you have to watch this, because this is a time when there is a risk of a sharper downturn. And as a policymaker, as a Fed official, you're going to be particularly focused at this point on labor market development.
What is your probability that this is a deeper downturn?
Well, we have said probability of recession over the next 12 months of 30%. That's where we are currently. I think that's not too far from the consensus. Last number I saw was somewhere in the 30s. It's come down a little bit because on the GDP growth side, things actually have been a little bit better. And this, it's the passage of time. If something doesn't break for a period of time, then you're more likely to sort of get to the other side. But there's still a risk, and that's why policymakers need to watch it.
Is this economy, could you consider it stall speed?
I think we are close to stall speed. Where exactly we are relative to stall speed is hard to know, but that is the historical regularity, that the unemployment rate either doesn't go up at all or it goes up a lot. And there's not a lot in between. You can sometimes see a few tenths of a percentage point of increase, but usually if it's more than half a percentage point or 3/4 of a percentage point in a short period of time, that is a recession. We're not there yet. The unemployment rate's still low, 4.3%, but it requires vigilance.
You mentioned that the economy could be reaccelerating into next year. What are the factors that would do that?
Yeah, so just to be clear, in the remainder of 2025, we still think it's going to be relatively slow. But once you get into next year, I'm expecting the Fed to cut rates. I think they're going to deliver 3 cuts in September, October, December, and then probably another couple of cuts next year.
Or 3, 4 or 5? I've heard as much as 6 or 7.
Well, we have 5 cuts through the middle of next year, so 125 basis points from here. That is a supportive factor. Fiscal policy is going to turn expansionary in the first half of next year. This year, fiscal policy, if you include tariffs in fiscal policy, is a drag on growth. Next year, fiscal policy is going to be a boost to growth. So that's probably going to help. And then it's just the passage of time. I mean, if we manage to get through this slower period, then I think the risks that weakness feeds on itself diminish.
Clearly, of course, rate cuts now coming into focus, markets trading up on that. As the chief economist at Goldman Sachs, how worried are you about Fed independence, or is this just a talking point?
Well, I think independence of monetary policy is very, very important, and we have done significant research on this. There's a lot of academic evidence that independent monetary policy over time delivers lower inflation rates. And you can see that in a variety of ways. You can just look at more independent central banks versus less independent central banks, what average inflation looks like in those two cases. You can look at changes in the legal status of central banks and monetary policy committees, and if it moves in the direction of less independence, you do end up with more inflation and vice versa. So it's certainly something that we're focused on.
The Fed has challenged the Trump administration has challenged Fed independence. It has also challenged the quality of economic data. As someone that crunches numbers and has been doing this for decades, do you still believe in the quality of economic data in this country?
Well, I think that historically, US economic data has been really preeminent in terms of quality, and that's particularly true for the labor market numbers, where there is a lot of very timely information. You get weekly data on jobless claims, 5 days after the week to which the release refers. You get very comprehensive establishment survey and household survey data just shortly after the month during which the event occurred. So all of that is not necessarily available in many other countries. Now, it is true that economic data is imperfect. Government data is imperfect. Private data is imperfect. I'm a big fan of averaging lots of different indicators that purport to measure the same thing in order to get a more accurate picture. And there's certainly room for improvement, speeding up benchmark revisions, building new information about new firm creation into the payroll data more quickly. So, but that is going to require resources. And I do think that spending those resources, it has a high payoff because we all benefit from having the most accurate data possible.
So true, and congrats on your award. On crunching some of this economic data, I know you're one of the best in the game. Jan Hatzius, Goldman Sachs Chief Economist. Always nice to see you.
Thank you, Brian.